Welcome to the economy. Well, there's lots of economic news. The global ecosystem has worsened slightly for the economy, for the Indian economy. But the Reserve Bank policy has provided more rate cuts and more liquidity. This morning, the governor speaking to the Business Standard has sounded a bit dovish by saying that rate cut space may open up if inflation comes below the RBI's forecast. And finally, of course, we had the May trade numbers, and they don't show any impact of the Trump tariffs as of now. But to understand all this better, I have with me Santanu Sengupta, the chief India Economist for Goldman Sachs. Shantanu, you know, there's some timing here. We're just getting pictures of Trump leaving the G7 meeting. I would guess that the leaders would have wanted to prevail upon him, to prevail upon Israel. But from the reports we got, they seem to have prevailed upon him only about the tariffs. Anyway, that footage will be just running for you in a minute. I wanted to ask you, what have you made of this new West Asia problem? Is that disturbing any of your macros, growth or inflation? I mean, crude is at 74. We probably didn't expect that.
Yeah, so the forecast that we have built in for our macro numbers are around $65 a barrel. So if it settles at 75, and settling is important from a macro perspective instead of just a spike. If it settles at 75, clearly the macros will be slightly worse. But remember, the direct pass-through happens on the current account side and consequently on growth. The starting point of current account is very comfortable. So you're starting with, our forecast at 0.7 to 0.8% of GDP. $10 increase would mean around 35 to 40 basis points increase. Even at early, 1.1% of GDP or so, the current account would seem eminently controllable. On the inflation side, frankly, we haven't really had much pass-through of either oil price fall or increase in terms of pump prices over the last couple of years, 3 years, and the government through the fiscal and the quasi-fiscal, which is the OMCs, have absorbed this shock. We expect that to continue even if oil price rises to 75. Slightly more stress on the fiscal, but at 75, it should be still manageable.
Okay, but would the geopolitics disturb other factors, like, a further slowdown in global growth? Because you guys were the first to bring down Asian growth rather drastically after the April 2nd terrible reciprocal tariffs, justifiably so. I'm just asking you if West Asia has made you all change any of the global macros, and if the world slows, will it impact us?
So undoubtedly, if the world slows, it will impact us through the external balances channel. We haven't made any forecast changes yet. Still early days. One thing that we found in our analysis over the past month from the trade uncertainty is that it has a significant impact on Indian investment cycles. So the external uncertainty impact on Indian corporate investment cycle or private capex investment cycle is pretty significant. As the uncertainty stays elevated, first due to tariffs and now due to what is happening in West Asia, that is going to have an impact undoubtedly on the corporate capex.
I thought you all have upped your calendar GDP, right, by 20 basis. Have you done anything to your FY26 GDP? You all were at what, 6.3?
Our fiscal year number remains unchanged. Our calendar year number has been raised to 6.6. That's mainly because we got surprised on the upside in terms of Q1 calendar year or Q4 fiscal year 25 growth. Again, the GVA was in line with what we were thinking. The GDP surprise is not something that we expected. But overall, I just want to make the point that we are feeling more positive about growth. We think that we are moving towards a more positive growth inflation balance. A lot of that will actually play out in our view in FY27 or calendar 26. You're already in the middle of the calendar year 2025. You've had a material amount of monetary easing. Fiscal is not as tight as it was last year, as the government wasn't spending. That spending is coming through. So all the domestic levers of policy are getting more loose this year than last year. With a lag, we think that growth will be better in FY27. So we are at 6.7 for the fiscal year 27.
Okay. 6.7 for FY27. But for the current year, FY26, you are at?
We are at 6.2.
Okay, so you're lower over there. I spoke to a lot of bankers after the monetary policy, which has, given or ensured liquidity even in the second half. First half, obviously, we could see the liquidity with the RBI dividend. It should continue. But they have promised even in the second half. Even then, bankers tell us they don't see demand. Money is there. There isn't so much demand. Any such worries, or do you think that this super liquidity will solve the growth problem?
Well, rates and liquidity to the matter, to the extent that it impacts the overnight rates is only a price signal. It's not really a quantity. Our central bank doesn't really go out and say that lend X amount of money to Y.
Yeah.
So the RBI is still trying to treat it through the price channel. Look, again, there are some mixes going on within the overall growth. Consumer is looking better in our view. The bottom end consumer, especially given a strong rural cycle, food inflation lower, should provide a real income boost. There's a bit of fiscal transfer you're seeing already over the last year or so at the subnational or the state government level. All of that is looking good for the bottom end consumer. The top end consumer was doing okay. The capex part is where it is more sector specific rather than broad based. Look, we are again not building in a very strong recovery in credit demand, but what will happen is that possibly you'll bottom out at the current rate of growth of credit in this quarter next, and head higher in the second half of the fiscal year.
Yeah. Okay, hopefully. Shantanu, I wanted to ask you about the governor's interview to the Business Standard today. Are you getting a sense there can be one more rate cut? He said if inflation surprises below our forecast.
Look, again, our inflation forecast for the second half of the calendar year, which means that the next quarter and the quarter after, is averaging 3.5%. We are at 3.4 and 3.6. I think the key in terms of monetary policy easing is the forward-looking inflation. So let's say you're considering a rate action in either the August or the October meeting. So let's say you're in the October meeting, the 1 quarter ahead inflation number is looking somewhere in the region of 4 to 4.5%. If growth is okay at that point of time, the question that the RBI will be asking is that do we really need to cut 25 more at that stage or not? If growth slows down, so that's our point, that if growth slows down by the time you get into the October-December quarter, undoubtedly there's a rate cut.
There's a chance. Okay.
Two, more importantly, there's an exogenous element here. Let's say China oversupply leads to regional deflation, especially in core goods inflation, and therefore you start seeing the core inflation turning in the back half of the year. Absolutely, that opens up room again for the RBI to ease rates. On the basis of food inflation being low, our sense is that you're seeing really the best of this.
Yeah.
Vegetable prices can go down only so much, and we know the nature of perishables inflation. It's highly volatile.
Yeah, fair enough. We have to watch out for the Chinese engendered deflation. But today we had the steel secretary, and they have built a lot of defenses against ultra-cheap Chinese goods coming in. So let's wait and see how things pan out of there. Shantanu, what is your sense, either from the press conference or from what he has told Business Standard, about how RBI will keep the overnight rate? At the moment, the overnight rate is a good 25 basis below the repo rate. Do you think they will continue to keep it there because inflation is going to read like, 2.5 and 2.7, even as far back as October, it may read very low. It may read at 3%. So do you think they'll keep liquidity very loose in the sense no VRRs and the call rate is at 5/4?
Again, our view is that in a rate cutting cycle to aid transmission liquidity surplus and keeping the overnight at least below the repo, if not at SDF, is going to aid transmission. It's going to be the best for transmission. If you see the bond curve in India, it has actually backed up higher pretty much across segments. Whether you see the 2-year point, 5-year point, 10-year point has backed up higher post the policy meeting. Even swaps are higher. Now, The back-end swaps we would have expected to be higher because you're basically calling the end of the rate cut cycle with the neutral starts. But short end, we would not have really expected to move. So we would have thought that the curve would steepen. There was some steepening, but then the short end also moved higher. That is because the market is probably interpreting a little bit of conflicting signal in terms of liquidity. Our sense still is that liquidity will remain benign till the end of the year and the overnight will remain below the repo. If not 25 basis points, at least in the region of 15 to 25, somewhere in that region, below the repo for the foreseeable future. Also remember that the CRR card gives you that clarity on liquidity at the back half of the year.
That's right. Yes, I too got the impression that even if there is an occasional VRRR, the Reserve Bank wants to keep the call rate, closer to the SDF, as long as the transmission is in the early stage. As it moves up, if there are signs of aggregate demand or asset bubble, he even referred to that in the Business Standard interview, then maybe he'll change his mind. Finally, Rupee. It's not even a story now because it's moving in some kind of a range. But now, do you see Rupee appreciation, given what you say about the trade, the current account deficit not being high?
Yeah, because you said Rupee in a range, I'll just point out that the volatility in the Rupee is higher now than what it was.
Yeah, quite crazy.
Months back. True. So the way we look at it is, when you look at the interest rate or the carry to arrested for the vol, Rupee was screening as the highest amongst emerging market peers 6 months back, including Latin America and CEMEA currencies. Today it is slightly lower. But to the Rupee question in terms of dollar Rupee, our view is we have a house view of a weaker dollar. That's not very different from consensus right now. But our view is that the Rupee will not really appreciate materially because of the short forward book that the RBI is running. Our sense is that whatever flows that the RBI accrues will be used to knock off some of the forwards and get it down to a point which is relatively more manageable, is what we think will happen at least till the end of the year. So over a 3 to 6 month horizon, our appreciation in the Rupee is very little. We have about 84.5 in terms of our forecast. It is only on the 6 month horizon where you can see a move closer to 83.5 or so. Again, remember, our CNY view is that we move towards 7. So even as the rest of the Asian currencies appreciate, we think that the Rupee will appreciate, but by a lesser amount, mainly because of the short forward position.
Okay. Thank you very much, Shantanu. Out of time, but I'm going to take a rain check from you literally because I saw that excellent report of yours where Goldman Sachs and Shantanu are arguing that we have a huge tailwind with women entering the workforce. So a Womenomics interview sometime later. Thank you very much for joining us. Well, that's it on Bazaar. Chartbusters coming up.